and I like to set up a. Um, I love theta decaying. I love theta that decays. Okay, so and that's due to the only two strategies that I do, and that's cash covered calls and um, it's cash secured puts and cover calls. Okay, cover calls, cash secured puts. Okay, so to make a long story short, so I get right down to a little math, and I hope the math will be able to help you. Um, okay, so let's just look at a stock. Okay, you choose a stock. Okay, so I'm sure you see a lot of things online already. But we're going to look at the cash secured put, and we're going to choose a stock. We're going to choose Clover. Okay. Um, why do I choose Clover? Okay, for one, I like to choose stocks that are not so expensive. Okay, my strategy with cash secured puts, cover calls, I personally, this is my personal choice. I say between $9 a share. I'd say between, I would say and $9 a share. Okay, I may even drop to 4 a share because it all depends. I'm gonna tell you, it had to, be high, relatively. But I'm gonna tell you why. Because when you go online or when you look at YouTube or you hear anyone who trade cash secured puts or covered calls, the main thing you hear is that they lost some money. And so when I first started trading cash secured puts, the first thing I look for is the bottom line of what can happen. What is the worst thing that can happen? And the only thing that I see that's the worst thing that can happen is individuals who buy stocks, who sell covered, who sell cash secured puts, or who sell covered calls at stocks like that's $200 and $300 a share, $400 a share, $130 a share, $160 a share. And let me tell you something. And you can believe this, or I'm sure you can have witnesses yourself. I don't care what technical analysis you use, I don't care whatever you use. Stocks are completely random. Unless you unless you're doing maybe a zero DTE, 0 days of expiration, you can kind of gauge. But if you're doing like maybe a week, most people do a week, 30 days of cash secure puts or cover calls, a week to expiration. Stocks are very, very random. You go into a stock that's $180, $200, $250. Tomorrow, that stock can drop 60, 70 points, could drop 40 points, could drop 30 points. And you have 1,000 shares, 300 shares, 500 shares. So I don't. The bottom line is I don't want to get into stocks that high price. I don't want to experience a drawdown like that. Okay, because they sometimes don't recover right away.
For another installment of Sheridan TV. We'll see you then. Take it easy, guys.
And I don't want it tying up any money. Okay, so now, so the reason why I do go in stocks is, between $4 and $9 is because the risk management is better for me. For me, the risk management is better. And I mean, I don't get, if it draw down, I may get a 2, 3 point drawdown. If 3 points, if that much. If that much. Okay. But it's safer for me. And what I'm looking for in my trading is consistency. Consistency. And doing things that's highly, highly predictable. Okay. Nothing is a guarantee in life, but um, so far, Cash Secured Puts has been an ATM machine for me. Okay. And hopefully it'll be the same for you. Okay. So what do we have here? Okay. So we have this, we have that. Okay. So what happens next? So what we do is we wait. We look at this and we wait, and we want to keep the 7.5. We want to keep the stock price from dropping below 7.5. Okay. So let's speed up. So our expiration is May the 21st. Right. So let's speed this up then. Okay. All right. Let's drop it down a week. All right. Let's go to May 10th. Okay. Let's take it, and we're going to keep an eye on the premium and see what the premium does as we get closer to expiration. Okay, still buffering out. Okay. Okay, so the premium increased. Why did it increase? See this premium, it did increase. Okay, you know why it increased? Because you had the stock, you bought the stock at $9.50, I believe, and it decreased. The stock went into the money more. It went not in the money. I'm sorry, but the stock actually decreased down closer to 7.5. So it's not in the money, but it did increase. So it pushed some premium the opposite way. But it's not a bad thing. It's just that you still got some time. You still got 11 days left. Okay, it's not in the money. If it expires tomorrow, you'll get the 175 that you collected. Okay, but as it get even closer to the money, you'll still see some increase, and because of the volatility as well. Okay, and the volatility is pretty high. It's trading pretty high. Clover trades pretty high volume. Let's take a look at the volume. Okay, well, it's 11 o'clock and they trading 3 million shares already. Okay. Okay, so let's get a little closer. Okay, let's get a little closer, and let's see what happens to your premium. Okay, it expires May 21st. Okay, let's get a little bit closer to May 21st. Let's go down another week. Okay. Okay, still buffering, pre-buffering out. Okay, here I go. It just came up. So now it's in the money. See? That can happen. Now these are real things that can happen when you're trading. When you're trading, selling puts. Again, you still get the 175 is still yours. You got it. But as you can see, it's in the money now. Your stock is in the money. Your cash secured put is now in the money. Okay? And now it's at 90 cents. Okay? And you got it at 17 cents. You sold it at 17 cents. So it increased. So now your net link has increased. Okay? But it's not over yet. Okay, still more you could do. And now this is where the management comes in at. Okay, so all right, so let's get a little bit closer. All right. So let's go to actually 21 is your expiration. Let's go to 19. Okay, so there's 2 days left. You're in the money. It's 687. So you're in the money some, right? Um, so it looks like you have um, you lost a lot of your extrinsic value. You have more intrinsic value now. Okay, so that's not good for this trade. So what happens is this. What we're going to do is we're going to just, this is the management side of this. We're going to just roll this trade on into next month. So we have it now at the 21st of May. I mean, June. I'm sorry, 21st of May. We're going to roll it to June the 18th. Okay. Which is the following month. Okay. So let's take a look at this. Let's take a look at the trade tab. Right, because it's not weeklies on here. Okay. I was wondering. Typically, I only trade with weeklies, but it's not weeklies. But just for the sake of math, we're going to do this. Okay. Okay, so we're going to go out another month. Okay. Let's roll it. Let's roll it out a month. Okay. So we'll roll it out to May, June, July, August. Okay, just for the sake of math, we just roll it out. It's on the demand, so sometimes it doesn't act like when it's at the live trading. Okay. All right. So what happens is this: you have 17 cents here. Okay. So we're gonna roll it for some more credit. So when you roll it, you get more credit. So you have 97 cents here, and it's gonna add up to 97 plus your 17. So you was getting 175 in credit. So now you'll be getting more. You'll be getting more credit, 97 cents worth of credit. So let's do the math for the 97 cents. Okay. So it should be 97. So it'd be 2,000 times. Okay. It'd be actually $1,900 extra. Okay, so it'll be $1,900 plus the 175. Okay, I believe that's about right. 170, 175. Okay, 21.15. So that'll be your premium now. All right. So let's go ahead and sell this. Let's go ahead and sell this. Okay. Okay, 92 days, 10 contracts. 175 is your trade price now. Okay. Your cost basis dropped. Your break even dropped. So 625, I believe it is. This is how you check out your cost basis. Okay, your trade price is 175. You have 7.5 minus 1.75. Okay, your cost basis now is $5.75. Okay, your break even is because of the premium you collected. Okay, so you're not in this trade anymore. You rolled it into August 20th, and your premium stacked up, and you had $1.75 premium, and your your premium. I'm sorry, your trade price, and your premium here is at $17.50 now. Okay, because you added on, you collected some more money. Okay, so we want to get this above 7.5 by August. Okay, so let's trade this and see where we at. All right, so we have more premium and we have more time. Okay, that's you just did a simple roll. Right. So let's move forward. Let's go into, you have August. Let's go into June. So we went to June the 14th because we can go all the way to August the 21st when it expires, but we just didn't follow much with this June. Okay, it's still buffering, pre-buffering now. It hasn't settled because when you click it up, it takes time to settle out first before you get the number. Okay, so this is what happened. Okay, this is no longer UC zero quantity. So this is the one we rolled into. So now you see $10. I'm sorry, 10 option, 10 contracts, which is 1,000 shares. 66 days instead of 25 because we rolled into August. Okay. Trade price, it increased from the 17 cents to the 94. So it was 17. So 17 plus the 97 equals 114. Okay. It would have been evened out more. But when you on demand, the numbers get a little cloudy. They change a little bit. It's don't be really exact. Okay. But that is the bad. Okay. So the trade price always stays the same. Okay. Of course, it changed when we rolled it, but it stays the same after that. The market price, it starts off equal to the trade price, but as it decays or increases, it changes. So now it went from $175.75 to 52 cents now. So if it went down to 52 cents, your net from 1,000 and some change dropped to 500. This means this is what's left. There's $525 left on your premium that you collected. What's in your bank account is $12.25. This was $17.75, I believe it was. Now, because why did it change that way? Okay, the market price now for you when we first bought this, when you first sold this, the stock was at $9.30, $9.50. Okay, then it dropped to $6. It dropped under your strike, which is $6. It dropped like $6 and some change, right? And then you rolled it because you didn't want to sell it at a loss, so you rolled it to give it some time to adjust. So you rolled it out. So now you rolled it out to August to give yourself some time, and you kept the same strike price, same quantity, but you had 66 days now instead of 25 to give yourself some time. And you also got a credit for that roll. Okay, you increase your premium that you collected to $1,700 from $175 to $1,700 premium, which is good. You just wait a little bit longer to get it. Okay. So now, this what happened? Why did it? What happened? Why did the number get? Why did your premium decrease? Why did you gain $1,200 in your account? Why did you gain this? Okay, because the stock price is now at $14. Your strike price is 7.5. The stock went up to $14 from the stock went up to $14 from where you originally it's not showing. I was trying to get a gauge on, get a good visual on it. Okay, so we're not gonna do that. Okay, so the math is that because the stock shot up to $14 from $9.50, you have it increased. It allows you to get your premium quicker. Like if you sell an option, sell a covered call. If you sell an option, a cash secured put, if the stock just happened to shoot up 2 or 3 points the next day, you get your premium that much quicker. Your premium will increase that much faster. Okay, to increase from your buying power to your pocket to your bank account. Okay. So now this is an option. Let's get to this. So now you see you have $1,200 in premium from the 17. You have 525 left. Okay, so let's take a look at the percentage. Okay. Percentage. Let's add the percentage. Okay, the P&L percentage. So now you have 70% of P&L. Yeah, and usually people collect they usually close it out after 50%. Some people, most people do. Not everybody. Some people wait till expirations. But in your case, because anytime a mistake happens or a mishap happens, like you had to roll it or any adjustments you had to do, anything you had to straighten out in your trade, you always want to close it out as soon as you can and add a profit. Okay. So this one here is getting. We're gonna close this one out. We want to take the $1,200. We're gonna leave this on the table. We don't need to try to get every drip drop. 1,200 is enough for this trade here. Trying to chase every dime of the trade, and sometimes it goes against you. And none of that, but we came out of an adverse situation because we had to roll in here to get some more time. Okay, because it was we was in a losing position, but we had to manage the trade, and we managed it pretty well. So we're going to take that $1,200. We're going to close it out here. It's at 52 cents. Okay, let's see what we could make on that. 54 cents. Okay, let's close this out. Yep, closed out. 53 cents. Yep. So now, the P&L from here. The P&L from here. $12.22 is in our account now. 1222 is an out count. This is how we close that out. Okay. So until I do the next video, we'll just see you next time. I'm gonna do some more math on the cover call video. All right, bye.